Hi guys, today I'll be showing you a very simple method and strategy for analysing supply-demand zones for any major asset and how you can incorporate it into your trading at home. So first I'm going to load up the predictive ranges within Lux Algo Premium. You do this by going to the settings, going to SR mode and selecting predictive ranges. The value next to the predictive ranges toggle will adjust how macro the displayed ranges are. The higher the value, the more major and less frequent a new range appears. For this strategy, I'll be wanting more frequent ranges, so I shall change this value to 4. Then, I'm going to do a little trick that I use to have two Lux Algo support resistance methods on my chart at the same time. What I do is I add another version of Lux Algo Premium to my chart, and then I have two copies of the script. In this second version of Lux Algo, I'll turn on the institutional profile here within the SR method. The institutional profile has been designed to have a familiar look for users, so it has the appearance of a volume profile. However, it has a very different approach to its calculations. The profile uses Shalen's hypothesis to derive the institutional activity in a given range, and then will display the information as horizontal bars. This allows for a baseline analysis of where institutional activity may be focused and where the algorithm believes institutions were entering positions. Now that we have both the predictive ranges and the institutional profile added to the chart, we want to use them together in confluence to identify these major areas of interest. So identifying these areas is fairly simple. We want to look first at our volume profile. Here we see there is an increased amount of institutional activity around this level firstly, and we also see it is very close to the predictive ranges midline. So from this we can conclude that this area is clearly a significant area that institutions are interested in buying or selling at. So we can create a zone here around this level where we may want to take profit, we may want to enter position. So let's take a look at an example on my chart. Here you can see the dotted line and the surge in institutional activity and the midline of the predictive ranges are in the exact same location. So what I've gone and done is drawn a pink box where I believe the supply or demand or support or resistance levels will fall. So let's see how that plays out. I've turned both of the indicators off to just show the level. So now looking at our chart, we can see that played out quite nicely. We can see the price interacts with this zone frequently. Here it knocks against the zone and we get a candle with a huge upper wick, so it was clearly rejected at this level and it constantly attempts to retest this zone. Then here we have one more smash against the zone and the price falls all the way down by about $2,000. So how could you have traded this? From the very large upper wick on this candle, we can learn that there was a strong bearish pressure at this level. The price was constantly being rejected around this zone. Therefore, we can establish a bearish bias here. What I like to do is use the Lux Legacy Oscillator to confirm trends early. You can turn this on by going into the settings for the Lux Oscillator, selecting Legacy from the type, and then in length, setting it to 50. I normally use length 50 because I feel it gives a smoother trend identification. And what I've also gone and done is add the Lux confirmation signals. You can do this by going into the settings of Lux Algo Premium, selecting confirmation, and I have them using autopilot mode, which you can select here. So now we have all the indicators added to the chart. Let's see how they would have helped. We have already established our bearish bias earlier, so we should particularly be looking for bearish signs from our indicators. If we were to notice some bullish market behavior, such as a zone break and a retest, then we would reevaluate our position. We firstly see our Lux Legacy Oscillator seeing a move towards being overbought, and it approaches these levels. However, the price doesn't seem to move with it. We then see it become bearish shortly after, indicating a possible downtrend. We also see a strong sell signal from the autopilot signals, adding confluence and suggesting the market's direction will indeed be downwards. And shortly after, we see large bearish candles appearing. Not only can these zones help with identifying market bias, they can act as fantastic and logical areas to use as entries or targets for positions. Take the Bitcoin daily chart as a clear example. I've extended the zone that we drew earlier. For those who like to invest and buy the dip, this can be extremely powerful. As we can see here, the recent rise in Bitcoin saw a break of this zone, and then the price came back down and wicked perfectly into the zone, and this would have been a great opportunity to buy the dip and re-enter a position. This strategy and theory can be applied to absolutely any time frame, no matter how large or small. So thank you for watching. Don't forget to leave a like and subscribe, and feel free to leave a comment telling me what you'd like to see me cover in my next video.